I would tend to have anything where between 30 plus pips on a stop, but my target's 5, 6, 7, 800 pips away.
Exactly. Yeah.
I've had even trades go to 2,000 pips. Obviously, I don't hold all of the volume,
Of course.
because obviously partials and risk management. But yeah, my risk reward is still pretty decent because obviously I'm swinging it for such a long time. So
How have you developed that patience? Was that always your style? Were you scalping or day trading before adopting to that?
yeah, I was. Yeah, so that's how I was taught anyway. Is called intraday, sort of intra-weekly. I'd say I was more like I'd hold it for a couple of days and then exit. Until I realized that actually I prefer to understand the reason why. So I did that sort of pre-COVID anyway. That was sort of my strategy until I actually understood or started to understand why the markets move. Now it's the fundamentals, and I realized that actually, you know what, I probably need to run with the guns, right? So I need to say, okay, I see your dollar falling this because the ECB is doing this, the Fed's doing this, something's happening in China, that's bad for Europe, for example. That then allows your dollar to fall 300 pips to the downside. And then I just naturally just developed into it. I think it's personal as well. So for yourself, let me ask you, do you see yourself do you swing trade or are you more intra?
Funnily enough, I recently switched to sort of trying to swing trade. So far, it's been more intra-week. Like I've held a couple of positions over a weekend, but it's not been swing trading to the degree of, say, more than a week so far.
Yeah.
I'm trying to develop that because I've been scalping for the last 3-4 years. So it's quite ingrained, that sort of lack of patience. I feel I have the patience. It's just that I haven't analyzed something yet with a long-term target to hold or try to hold that target. But yes. So I've just transitioned to swing trading. So I'm trying to build the patience or at least find the analysis. I don't have that clarity just yet on a higher time frame perspective, and I don't have the understanding of fundamentals either to sort of aid that. So I don't have like a bigger picture play I'm trying to trade at the moment because the markets in January actually been very interesting. They've been a lot of the pairs that I've been looking at are all sort of sideways. Yeah. Plus, as a scalper, I was only trading EU, so I haven't started. It's been an interesting time, but that's one thing as a swing trader I'm trying to get used to, of looking at other pairs and actively trading other pairs because I can now. I just haven't yet. I've literally I changed in like November to sort of swing trading, and therefore since then maybe a handful of trades on EU, as you can imagine. Like December was quite nice, we had some decent movements. That was quick. But then January we just completely have crunched down into a range, which is no problem. Like I expect we will expand at some point, maybe this week, obviously with the Fed this week, NFP this week. That's my hope. That's my hope anyway.
Yeah. So the markets would use the data as a catalyst because they always need a catalyst to move the market. So they'll wait that's why the markets have consolidated, is because they're unsure of what could happen. People have their views, like, for example, HSBC are massively bullish dollar this year, whereas Goldman Sachs and BNP Paribas are massively bearish it. So they have their own views. So what they'll wait for is the data to confirm that view, and then they'll run with that. So, for example, if this week the Fed reinforces that the Fed isn't going to cut anytime soon, the dollar will rally because there's a lot of cuts priced in. So cutting rates is obviously bad for the currency. So if those get pushed back, all the way into the year. So at the moment, markets expect May. If they get pushed back to June and then July, that pushback is what drives the dollar higher. But if the Fed reinforces those cuts this week, the dollar will sell off because it just allows markets to actually say, hey, you know what? We could probably price in a little bit more cuts because they're a lot more dovish than we expected. So they need catalysts. The markets need catalysts.
So why is that though? So when the interest rates are coming down, why is that bad for the currency?
So it's bad for the currency for a couple of reasons. Number one, in terms of the dollar. So because, dollar drives everything, right? So when the markets are cutting rates, or the Fed, for example, what that creates is it becomes a little bit cheaper to borrow money. And the equity markets are propped up on debt. So as it becomes cheaper, people pile more into equities. That's why it's known as sort of that risk on. And that drives the dollar lower because they're pumping money out. They're pulling money out of the dollar and putting it into riskier assets to gain yield. So that pull out, pushing into Australian dollar. That's why if you're looking at December's price action, when the dollar sold off massively, because obviously the Fed was pretty dovish, Aussie dollar rallied extremely aggressively. And that's because it allowed the markets to think, it's actually good for risk, good for risk appetite, bad for the dollar. Dollar is seen as that safe haven. That's why during COVID it pumped really aggressively. And they'll think, okay, who is extremely undervalued? And then they'll go to Australian dollar. So I can tell you if you want how HSBC trades. You want,
Yeah.
yeah.
Well,
So
everyone always says we trade like the banks, right?
Yes,
and you
no,
probably see that quite often.
doesn't work.
So what
like
is the
that.
reality of the banks trading?
So I'll tell you. Number one,
The lowest prices in the entire industry with challenges from just $35 and payouts in as little as 5 days. The expert challenge is finally here. Get funded up to $100,000 at skilled funded traders with unlimited trading.
buy the most highest yielding currency versus the lowest yielding. That's why if you look at USD JPY during 2022, it rose massively because the markets were buying USD, of course, because one really hawkish. Bank of Japan was super dovish. Then that allowed to one, get carry. So they're making money on the trade without even the price moving. And two, they're obviously making money because the Fed was pretty hawkish.
Yeah.
So that they will make money on the actual price movement as well. Number two, what they'll then look at is monetary policy trajectory. So monetary policy trajectory is who's expected to be the most hawkish. You want to buy that currency. Who's expected to be the dovish. You want to sell that currency. So that's why, for example, in December, we'll pretend about December because that was really nice price action. The Fed was super dovish or was expected to be really dovish based on what they said. Dollar got sold off massively. But at the time, the ECB weren't as dovish. So that allowed euro dollar to climb really aggressively, similar to GU as well. They'll then also look at moving averages. So people will laugh at that, I know that. But moving averages is just a confirmation to get in. They'll look at that on a daily time frame. I believe it's the 4 and 40 day moving average. They'll then also look at the, let me think off the top of my head, the most undervalued. So they'll buy the most undervalued currency on a 60-day look-back period. So they'll look at the last 60-day price action and say, who's been sold the most? Let's buy that. And then who's been bought the most? Let's sell it. So you can all you're doing is just looking for a divergence. So who's really being bought? Who's really being sold? Do the opposite. That's based on, of course, HSBC. And then the last rule, so number 5 is they look at valuation models. So a valuation model that is quite commonly used in a lot of banks is called REER. So real effective exchange rate, or REER. So what they'll do is do that model, which uses price, or the actual price action. It will uses interest rates as well to determine on a period, is the currency extremely overvalued relative to the model, or is it extremely undervalued? And then they'll look to buy and obviously sell. Buy the most undervalued, sell the most overvalued. So that's what they do when they look to trade. They'll look at all these rules and say, okay, which one is fitting the best? Yeah. But then they'll also look at like the data, the CPI to just add to that narrative. So
Definitely.
That's how they do it.
How do you know that?
Because I've got the rules. I can show you the screenshot.
Really? Where did you get it from?
So we know somebody who works at HSBC. He obviously gives us a lot of their research documents, a lot of their trade ideas as well. We can get access to that, which seems pretty crazy. And a lot of the theme we've noticed is the technical analysis is so minor relative to the reasoning. So that even from a logical perspective, surely there's more to trading than just looking at a couple of lines, right? And I know a lot of people talk about there's an algo to the market. I disagree. Reason for that is, one, let's just use logic. If there was an algo to the market, why is the hit rate still the same? Why are there still the same amount of people losing money? If there's an algo that people have solved, surely there would be more people winning. Would you agree?
I would agree, yeah. Would you say, though, that in terms of algorithms, I know there's like a narrative that among some communities that there's an overlord algorithm, if that makes sense. Like one algorithm that's like a master algorithm. Yeah. Would you say, however, there are algos that are being used in the market? Yeah,
like high frequency trading algos, but they don't use like RSIs and MACDs for how sort of MetaTrader algos do it. They'll use FX vol, so FX volatility. So they'll look at alpha, they'll look at beta, they look at gamma on, that's like really, I don't understand that much, to be honest with you, because I'm not like really into that maths, but a lot of people who are watching this will understand the maths behind that. And then they'll look at that and the discrepancies. And that's what the high frequency we're doing, is just profiting off the
very minute numbers. Yeah. No, definitely. And let's go into like a fundamentals masterclass, if you will, or fundamentals for dummies like me, you know, and hopefully some other people can join me as well back home. But you mentioned hawkish and dovish. Can you break down those terms for us?
Yeah, so it's obviously a common a very common phrase that's said in the market. Hawkish is essentially, is the central bank expected to raise rates? So that's hawkish. Is inflation trending up? You'd expect the central bank to be hawkish. That's why, from a reaction function. So the reaction of the market tells you everything. So when CPI comes in hotter, that's what the market rallies or tends to rally majority of the time, because the central bank is then expected to be hawkish because they need to raise rates to battle inflation. That's the main tool that they use to battle it. So essentially, are they suggesting that rates are going to be higher? That's it. So are interest rates expected to be higher? Are they expecting to hold it higher for longer? Which is a very common theme, especially now, because no central bank is expected to hike again. The next question is, when are they going to cut? So that was what we was talking about earlier about if that Fed this week pushes back on those rate cuts, that's them being hawkish because they're saying we're not going to be dovish by cutting rates.
Yeah.
We're going to keep rates high for longer, as high as we could possibly, to bring inflation lower.
So on the flip side of that, dovish would mean the opposite.
Yeah, they're just simply cutting rates.
So we have FOMC, is it tomorrow evening? Today's Tuesday.
Yes.
Yeah?
I believe it is, yeah.
Testing it out. I think it is, yes.
Yeah.
Normal 7 p.m. for the UK. And therefore, if they were to sit there and say, okay, we're looking to cut rates soon, how would that impact the market, as an example?
You would see the dollar sell off very drastically. So the reason why the dollar has rallied so aggressively this month, since the start of January, is number one, let's tail back to HSBC's trading rules. That was sold the most in that period. So you would say, okay, dollar's been sold the most, let's buy it. So it's actually more prone to upside than downside at that moment. But then also we had sort of data was actually relatively decent in the US that allowed the Fed or allowed the markets to push back on those rate cuts. So that pushback gave that dollar the boost. All you got to think is, why is the markets move lower? Why is the markets move higher? And just think the opposite. So the markets move higher because, number one, the data was pretty good. Inflation's slightly stickier. PMIs were pretty good. So PMI data, retail sales was all right. Wages was slightly sticky. So obviously if you get paid more, you tend to spend more. That creates inflation. That's why the markets move. That allowed the markets to price back or push back cuts. That gave the dollar the boost. So if the Fed actually says we're going to cut rates, that's completely opposite to what why the markets drove higher. So that then gives them a reason to sell off. So that's what would happen is if they do reinforce that, then they won't necessarily say, yeah, we're not going to cut rates anytime soon, or they won't say it directly. But if the markets will, that's why you have jobs in the banks known as Fed watchers. So they look at the minute discrepancies between what was said last meeting relative to this meeting. And that then says, oh, they were really dovish this meeting. Oh, they're really hawkish this meeting. Or it wasn't really said much.
That's what I was going to ask you then. So like going into an event like this, it is quite a catalyst and it's a reoccurring theme. So sometimes, I remember when I first started trading, NFP was like a huge mover. That was a massive thing. Like you would see a wick one side for like 10, 20 pips and then go the other way and then maybe come back, wherever it may be. Nowadays, I'd say NFP's kind of calmed down a little bit. Right? CPI seems to be the one driving that, or at least over the last year and a half, 2 years. But then FOMC, ECB, etc., that's always, that doesn't change. So coming into that then, are there little things that you can track as a trader to help you with these events, right? And to be on the right side of it, or at least analyze correctly?
Are you talking about in terms of
like FOMC, ECB? So like,
what would you look at in terms
would you look at? So rather than not just looking at, say, the release and maybe the press conference afterwards, and maybe you can touch on how important those press conferences are to understand and to listen to. But are there other things beforehand that a trader can look at and say, okay, this information, if I look at this information and I can dissect this information, it's actually helpful going into this meeting?
Yeah, so you can do a lot of back testing. You can do, not in terms of looking at charts, just look at like sort of previous meetings, what's happened, but look at the data. The data will tell you what's going to happen with the Fed. That's why the markets are leaning into a little bit of a hawkish Fed, is because we had a little bit of a wage growth was a little bit sticky. Our retail sales was not bad. CPI was pretty decent. And now the markets are leaning into a bit more of a hawkish Fed. So what you'll do is just watch the data. So go out and research. Or you can ask myself if you want to, but go out and research, why would a central bank be hawkish, or why would they be dovish, or why would they raise rates, why would they not raise rates, why would they cut rates? They'll look at the data, you look at the data and say, okay, since the last Fed meeting to this meeting, what data has changed? So you would say, okay, since the last meeting in December to this meeting, what has changed in terms of data? Has inflation come in stickier? Has wage growth come in a bit stickier as well? Has retail sales coming good? Has NFP been pretty good? Has the unemployment rate been good? And that would allow you to have an understanding of, okay, the Fed's a little bit more hawkish, and that drives the price beforehand. So if you can identify that change, that allows you to understand what the Fed is going to do, or what the ECB, or what the Bank of England. It's all exactly the same. You're doing exactly the same thing for the Fed, exactly the same thing for the ECB, the Bank of England, and then that gives you understanding on which currency to buy and sell. So watch the data beforehand, and that will give you an idea of what the central bank will likely do at this meeting.
Perfect. And what would you say in terms of the go-to data every trader should know? What would you say that is?
CPI, so obviously inflation. PPI, which is obviously just the producer prices. GDP, wage growth, retail sales, unemployment rate, PMI data. That's what I'd say, personally.
It's not a crazy list.
No, it's not. All you're doing is just understanding what has the change been since the last print.
Yep.
And what does that change mean? That's the most important thing. What does this data actually
I know a
mean?
lot of people will look at, as you said earlier, red folder news, and then they'll see, oh, it's green, so it's come out better. But they don't actually understand, but then the markets do the opposite, and they don't understand. Oh, not green, but it's like it's gone higher than the previous one. They may think that's good because it's higher, but they don't actually understand what it represents, as you said.
Yeah.
And so then they get very confused, like, oh, why is the price gone the other way though?
Yeah, this tends to be a reason for that. So when you look at PMI data on your or your not MetaTrader, your Forex Factory or Trade Economics or whatever sort of website you want to use for your data or your news, there's always underlying data. So services PMIs above 50 is good, below 50 is not, tends to be not great. But there's always underlying data to that. So there'll be prices component within PMI, which is inflationary. There'll be employment component, which gives you an idea of what NFP could be.
Well, this is what I want to ask you, actually. I think we can break it down maybe into a few steps that will help a lot of people get some insights, which is those key data points that you mentioned. Like, why don't we just break them down, if possible, break them down into just what they represent? So let's start with CPI being obviously a main one. What does CPI represent? How is that? Why is that number important? What is that number made up of? And maybe we can break them down for each of those key ones. And no doubt a lot of people will hopefully be able to, including myself. a bit selfish of me to ask, but no doubt it will give people a lot of insight into what these things actually mean. Because I know a big part of the whole fundamentals thing is that people just get put off by, and I'm one of them, of the terminology. The lack of understanding of what is CPI. Why is it important? What's it made of? Well, what is this number that comes out? What does that represent? Why do they then look at that number and then decide on interest rates? So maybe we can go through each of those key points.
That's a good question, or a good sort of exercise. I'll just want to reiterate one thing, and then that will allow you to understand 100%. What the other stuff is. There's two things. There's a good trader that we know. He's ex-futures trader. He's worked at a multitude of different institutions. He said a very good phrase that stuck with me for past, year and a bit. There's tradable macro and there's macro. So the reason why a lot of, including myself when I started, I was really worried about the fundamentals because there's so much to learn. I have to learn about trade balances. I have to learn about what's happening in China. There's so much, trust me. I was really overwhelmed. But then this phrase stuck with me is macro is everything added together, CPI, macroeconomics, trade balances, China, everything, models, everything. And then that gives a potential view of what could happen. Traders are going to look at it and say, it doesn't mean anything. Then it leads on to tradable macro, which is what does the market care about? So that leads us on to what you said before about NFP, why the markets haven't moved much in terms of NFP, because it doesn't really move the needle much for the Fed. And doesn't really move the needle much for what the Bank of England is going to do. So the markets will look at certain bits of data and say, okay, why the theme of the market, there's always a theme. So what is everyone talking about? Everyone's talking about cutting rates next. So now what you do is, okay, the theme of the market is what everyone's talking about. They're all talking about cutting rates. All we're doing is following data that will support that idea. So we then is follow data that would allow the Fed to cut or to raise rates. So in this instance, it's cutting. You'll follow data. So you'll follow the retail sales. You'll follow CPI. Forget about trade balances. Don't look at that. All you're doing is just following specific points. And then it crunches it down to such a small portion of data, it becomes a lot more digestible. So that's something I just wanted to reiterate because it's quite a good little analogy. And
I think it's important, yeah.
It's definitely a thing I've definitely taken note of. So yeah, in terms of CPI, So consumer price index. So it's essentially just the price of goods or the change of price of goods from the last print. So on a month-over-month perspective, has inflation coming a little bit higher, or is it coming lower? From a year-over-year perspective, has it come in higher, or is it coming lower? Then there's subcomponents of that. I can't remember all of them off the top of my head, but there's all subcomponents: food, alcohol, rents, housing, services. And all you're doing, similar to what I was mentioning earlier about the theme, is just following the data that supports the idea of what the Fed is looking at. So then you look at what the Fed is saying. They always mention housing. There's a housing component within CPI. Watch the housing CPI, or the component within CPI. They always talk about rents. Well, there's a rent component within CPI. Just follow the rents. Forget about everything else. Follow what the Fed is telling you, and that will allow you to cut out all the noise and focus on what's
That goes back to what you were saying about what's tradable versus just being a part of it.
Yeah. So that's essentially what CPI is. Just the price of goods, the change in price of goods. So a good sort of thing, because obviously we're in the UK, Freddos. So you know those little chocolate frogs. They used to be super cheap when I was younger. They were like 5p. Now they're like, what, 40, 50, 60p? So that's an example of inflation. It's just simply just the price change in price of goods and services.
And what about PPI?
PPI is similar to CPI. So consumer price index, producer price index is PPI. Okay. It's essentially what's the inflation that the producers are feeling. Now that leads us on to what CPI can do, because if the producers are feeling more inflation, they're not going to eat it up in their margins. They're going to pass it on to the consumer. And that's why you see a rise in price of goods in the shops, Asda or whatever sort of shop you go to, and that creates that inflation as well. So if PPI is trending lower, which it is, if it comes in lower, then logically, if they're a good company, they would lower the price of goods relative to what inflation is doing. So it's just what the producers are feeling, essentially.
Okay. And what about retail sales?
Retail sales is, the clue's in the name. What's this been spending like within the retail space? So how has spending been in John Lewis? What's it like in Argos? I don't think there's any Argos stores anymore, but what's it been like in Argos? And that just shows you how are the consumers spending. And there's a multitude of different components within that, but all you're doing is I tend to just look at the main headline figure just to see kind of, has people spent during that past period or have they not? And that gives you an idea of what inflation could be. Because if people are spending, what do you think the companies are going to do? They're going to raise prices. That creates that inflation. Okay.
And then unemployment claims, unemployment, people claiming to be unemployed. Why is that impacted though?
Because, or initial jobless claims, unemployment claims, they're pretty much near enough the same thing. But if people are claiming benefits, that tends to be for a reason. Maybe companies are laying off workers. So companies are laying off workers, that's a worrying sign, right? If you don't want people claiming benefits in your economy, you want them to be in jobs, you want them to be part of the spending process. So if people are now starting to claim benefits, then the markets think, maybe loads of companies have laid off workers, because you've got to remember people, they obviously use their salary to rent and stuff like that. If they come out of jobs, they're not going to sit there and like, okay, let me wait for me to get another job. They're going to claim benefits. So it just gives you an idea of how's the company's sort of health in terms of their the claims, or just trying to think of the correct phrase. How is the consumer in terms of the jobs market? So it just gives you an idea of what the jobs market is like.
Okay. And then, is there any others that were PPI?
PPI, wage growth. That's a really, really important one. Wage growth is simply, the clue's in the name, has people's wages growing? So if people's wages are growing from the previous month or some people tend to look at like the 3-month or 6-month average, just because it gives you a better idea.
Is that a news release that comes out?
Yes.
What does it come under?
It tends to be wage growth.
What? I don't remember seeing that. Forex Factory's letting me down. Is that something that would come up on there?
Yeah, it would tend to be called wage growth, or it will tend to be called, what's the other word? Can I look at because I think there's a...
You're cheating.
I've got to remember the...
Because I'm trying to think. I don't remember seeing that come up. Now I feel like I'm being cheated, even though I don't understand all fundamentals, just because I don't know that one.
Definitely one this week for the US. I just can't remember the actual name. They tend to be named slightly differently, but on Trade and Economics, it's wage growth. It's not loading for me, the internet, but
We're in the middle of nowhere.
yeah, true. But yeah, it's wage growth. On Friday, it's released with NFP. So it'll be unemployment rate, wage growth or wages, and then unemployment rate, wages, and then NFP.
Yeah.
So it's always released with NFP. So just look at the wage component within that. So essentially all it is the change in the wages element. So people are getting paid slightly more than they were previously. What do you think happens in that environment? People now see a little increase boost to their salary. Naturally, people will raise their cost of living. And that raise initially is going to create inflation because people now start spending, and that tells back to CPI. People are spending, companies will raise prices, and that creates inflation. So if markets see wages come in hotter, they now think, oh, maybe inflation will come in a little bit hotter going forward because wage growth is a forward-looking indicator. So it tells you what could happen in the future. And then that brings the thought process, oh, inflation may be up. Oh, that means Hawkish central bank. Oh, that means stronger currency. So it's always a step process that they go through.
Okay. That's very helpful. Was there any others? I think that was it.
Wage growth, CPI, PPI, unemployment rate, just simply the people are unemployed.
NFP?
PMI.
PMI as well.
Yeah, PMI. NFP is just non-farm payroll, so people who aren't in farm jobs, essentially. PMI is Purchasing Managers Index. So that's a really, really important figure, especially for the UK, actually. There's two subsections to an economy. There's services and there's manufacturing. So the UK, for example, is 75% services. So the markets do not care about what the manufacturing sector, because it hardly contributes anything to the GDP, which is the overall health of the economy. The markets will care then about services PMIs. So what it is Purchasing Managers Index. It's essentially like a survey that's sent out to all the managers who purchase all the goods for the company and say, okay, have you seen a raise in prices? How's your employment within your company? Have you got any supply chain issues? How's the backlog of orders? And there's like 5 or 6 components within that tells you each aspect of that services sector. Employment, prices, backlog of orders. I think there's a few others there, which markets don't really care. They care all about the employment and the prices component.
Yeah.
So if prices have risen, what do you think happens then? Potential inflation, a bit more of a hawkish central bank, stronger currency. So that's why you always look at the underlying.
So each of these elements, by the sounds of it, is like a knock-on effect when you understand it to then leading you straight back to the inflation and interest rate decision.
Yeah. So there's 3 main data you always consider. Number 1, GDP. So I mentioned that just very briefly, but gross domestic product, essentially is the overall health of the economy. Yeah. What they're spending, what they're receiving, everything. Then you obviously got inflation, and then you've got interest rates. So obviously inflation and GDP is important, and then interest rates is a component of what's happening with inflation. What you're doing is following those 3. And all the data adds to those 3 elements. And then that gives you an idea of what the central bank is then going to do, and then what the currency is likely to do. If you minus out all of the risk on risk off events, of course.
Definitely. Talking about those events, because we literally had something over the weekend, which I found interesting. Yeah. Potential US wanting to have some form of conflict potentially in the Middle East. How do those events, like war, right? We've obviously had Ukraine, Russia ongoing now for quite some time. This conflict in the Middle East with Palestine and Israel is ongoing and could be expanding. These sort of events, how do they sort of get a reaction in the market? How does that impact the dollar, for example?
Good question. So
let's take a break for a minute there, guys, because I want to tell you about the best trading tool on the market, TradeZeller. The reason why TradeZeller is the #1 trading tool that every trader needs is because you can do back
demand supplies. Yeah, because they obviously need to raise
again.
Yeah, so you're getting there. But yeah, essentially what it is they cut off the supply aspect that rose the prices. Now you got to think from a FX perspective, or a trading perspective. Who imports the most gas? What do you think? Who do you think imports a lot of gas? Similar to oil, actually. Think about regional as well. Who's next?
Regional,
Who's next to Ukraine?
Who is next to Ukraine? Does my geography come in?
Bunch of different countries.
I know like Germany's close by.
Yeah.
France isn't.
Yeah, they're Europe.
Europe.
Yeah. So
trick question, man. No.
Europe. Euro sold off massively because now their current account, which again is another aspect to trading, but their current account, which is an element of their spending, they've now gone into a massive deficit.
Okay.
So then the euro sort of massively. Dollar in that environment rose because it's safe haven. Euro dollar shorts were very, very clean. And we sold it massively from at the top, actually. And it went all the way down below parity. So parity is just 1.00, essentially dead on one. Went below that. And that's because it became a lot more issued. The economy was really weak. Inflation was rising massively because of that aspect of gas and from the current account and just regional as well. Then it leads us on to sort of the war in the Middle East. So similar framework is the region. Obviously, Middle East is very oil-based. Okay, if oil prices haven't risen much, there's reason for that because it hasn't disrupted supply yet. So yes, the war is happening, but the markets are looking at the data and looking at sort of how long it takes to deliver those tankers. They're not seeing much supply issues. That's why oil prices haven't risen much. Because the way they're doing it is obviously they don't go through the Suez Canal anymore. Yeah. They're going around the bottom of South Africa and then all the way to the left of Africa and going out. Because normally they go through Suez Canal, which obviously runs a little canal, runs through, and then they go out through the Mediterranean because it's a much shorter route.
Do you know how I learned about that canal?
How?
A TV show called The Crown about the royal family.
Yeah.
Imagine that.
My
that's
wife is
terrible.
actually watching it. I don't really watch
it.
Hey. I don't watch it. I'm sorry, I don't watch it.
I feel like I got stabbed.
I don't watch it.
No, but that's how I learned about it, which was so interesting. Because then now I heard, and then shortly after I watched that, and then saw these issues that we're having, now I understand. I'm like, wow. Then I can pretend like I know. But
it's essentially obviously the Suez Canal.
It's a huge detour, that is huge. Yeah.
But the way they've seen it is it's not made too much of a difference to them, and that's why the oil price hasn't risen much. So in that aspect, you now got to think, let's say there is a massive disruption now. Like they cut off all the ports, they start bombing ports and issues happen. Then yes, you would see a massive rally in oil prices. Applying that to FX, because we're obviously FX traders, who imports the most oil? Europe, or they import a lot of oil. Japan as well. Who exports a lot of oil? Who's actually going to benefit? Sounds bad, of course. You don't really want to benefit from a war, but who benefits a lot from those higher prices? Canada, Norway, because they export a lot.
Yeah.
So now you got to think, okay, from a trade idea perspective, Eurocad shorts makes a lot of sense because you've got massively importing Europe, massively exporting Canada. Pair them together. You want to be short euro in that environment, long Canada, Eurocad shorts makes sense. Then apply the same rate for Japan. From an initial perspective, you want to be selling the yen in that environment. Who exports a lot? Canada. CAD yen longs make sense. Not longs make sense because of that element of just comparing.
Yeah.
So in big environments where there's massive risk of events, markets forget about the data economically. They look at the now. So they'll look at, massive issues in oil. Okay, let's short euro, let's long Canada, let's long Norway, let's short the yen. And in that environment, that's a trade idea. So you kind of forget about the data in that environment when it's massively in your face.
Yeah.
And then again, from there, it's a trade idea. So it's pretty good.
That's really good. No, the way that all pieced together, really, really, really makes sense. And I think a lot of people are probably going to be sat there like this, which is good though, because that's the whole point of the podcast, is really to get as much value and education and gems, if you will, across. So the way I see it is that each podcast is like a book, you might not get every single minute is going to completely blow your mind, but even if there's just 5-10 minutes that really changes your perspective, that's what it's all about.
Don't get me wrong, it's really difficult. Like it's going to be really, there's a lot of work, but think about it when you've done technicals.
Yeah.
It's really overwhelming at the start. The more you do it, the easier it becomes. I like to call it eureka moments. Like one day, just you wake up and it makes sense.
Yeah.
You got to do similar with fundamentals. Like there's a lot of things to consider. Don't get me wrong, but you have to stay consistent. Consistency is key, and I think experience as well is the biggest lesson in trading as well.
I feel like that experience of going through these different data points, and as you said, backtest the data points.
Yeah.
And its reaction in the market. So there are charts involved there to see how it reacted.
Yeah.
And then being able to carry that forward. So it's the same process, essentially, as the technicals, right? You have to learn about it, learn the terminology, learn about what each aspect is, how it impacts the markets. Thankfully, again, like this podcast, I think has done well in terms of fundamentals for dummies, if you will.
Yeah.
And I'm sure there's more to go into, of course. But yes, learn that, back test it, right? See how it's performed in the past. Start to forward test, to, when we say live test, essentially be there live to see the reactions, etc. Collecting that data. And over time, obviously, through that experience and that consistency, as you say, is what then builds that confidence.
I agree.
So I don't think it's any different to the technicals.
It's not.
If anything, I would say, less so technical side, because obviously there's learning technicals and there's trading technicals, right? I would say it's easier to learn the fundamentals, if anything, than it is to trade, right? Like you're learning terminology. Yeah. You're learning, language, if you will. You're learning data points. It's still a strenuous process. So it's not like you're going to learn it in a week, right? You're going to understand it in a week. Yeah. What I mean is, in comparison to what everyone's trying to do anyway and they're doing poorly for the most part, right? Mm-hmm. Most people are losing. Yeah. Surely it can't be that hard to learn fundamentals. Yeah. Right?
It's just it takes a lot of work and a lot of people aren't willing to do that.
Yeah.
Like, don't get me wrong, it was really overwhelming when I started. Done it during COVID, so it's kind of perfect because I had loads of time anyway. But it then got to a period where I was super overwhelmed with data and everything. I kind of, when you kind of have that mind blank.
Yeah.
And then you just got to stick with it. Mm-hmm. And then eventually it just clicks and then you start learning more and more and more. Like last year I learned a lot with the bond market, which is really important in FX. Equities as well. Not too dabbled too much into equities.
Why would you say the bond market is so important? Because I had someone on the podcast called Ali ICT, and he's a big ICT guy, believes in the algorithm.
Yeah.
Right.
Interesting.
But he is one of the first people I ever spoke to who, said he watches the bonds, he watches the equity, he watches the something else as well, and as well as FX and so on and so on. He watches all these different things and its correlation and its impact.
Yeah.
He was the first person I ever heard talk about that, which was very interesting, but I don't have an understanding of it, like why the bonds, why do people watch the bonds? Why does it have an impact on FX?
Yeah.
What do bonds even represent?
So there's 3 pillars to FX. So the markets will lean on 3 aspects of everything because all the markets are interlinked with each other. Number 1, you got rates. So what are interest rates doing? What are the bond market doing? Because obviously the yield aspect. Number 2, commodities. So what we just mentioned about oil prices, gas prices, that gives you trade ideas. Number 3, equity markets, because when equity markets rally, there's a reason for that. And that tends to be because they're not slightly more risk on, they're happy with the risk environment. And then you think, okay, in that environment, dollar sells off, Aussie dollar rallies because it's risk on currencies, high beta basically. It's very sensitive. So from a rates perspective, which is the bond market and interest rates and everything between that, the reason why, number 1, you got to think, what is the bond market? So the bond market is, think of it like an IOU or a coupon. So you come to think of myself as the government, you come to me, I'd say, okay, I'm offering you 2% a year for the next 5 years. So you buy a 5-year treasury yield or a 5-year treasury bond. So the yield is the 2%. The way the markets would view it as is because it gives you an idea of what the Fed is going to do as well, what the central banks are going to do. So you look at like the treasury market, which is obviously the US. You look at the gilt market, which is the UK, the Bund market, which is the German bonds, the JGBs, which is Japan. You look at that and the markets from an investor perspective or from FX trader perspective, it gives you an idea of who's more hawkish. Because if yields are climbing, that tends to be markets are a little bit more hawkish because the way they view it out or the way the markets would view it as yields climb, it becomes slightly more risky because the reason why yields climb is it's seen as slightly more risky to hold because when rates are risen, you're higher risks of defaulting, etc.
Yeah.
Unlikely to pay it back. So the way the markets would do is they sell the bonds. It's a really complicated market, don't get me wrong. It's a super complicated market. The bond market is really, really difficult. But the way they do it is they sell the bond back. That pushes yields higher because now it has to, the markets or in the secondary market, they have to create a demand. The government also has to create demand. So they're saying, oh, people are selling their bonds. We need to push yields higher to make it more attractive. But the way markets will do it is as that yield climbs, it's slightly more attractive. Now investors from elsewhere are changing their currency into dollars to buy that treasury note. And from an aspect of a trader, that increases the demand for the dollar. And that's why it rises as well. So it gives you an idea of what the central bank is going to do. Because as central banks are raising rates, it becomes more risky. So the yield have to counter that. So it has to rise and rise and rise. The markets will think, as from a political aspect, number 1, US is pretty good, data is pretty decent as well, growth pretty good, etc. Okay, the risk of defaulting on that bond is super low. So let's buy that. And that creates the demand for dollars. So they'll do this exactly the same framework for the Fed and the treasury market. They'll do it for the gilt market, UK market, the bond market, the European market. So
because we had an issue with the gilts, right? Not too long ago, if I'm not mistaken.
Yeah, that was I think last year, wasn't it? When there was a lot of issuance.
That's when we had who's
Truss.
in power? We had some random person in power.
Liz Truss, wasn't it?
Yeah.
Liz
You're
Truss,
random. Who?
Yeah, the Liz Truss issue.
So the shortest reign ever as Prime Minister.
She gets paid 100 grand now. You know that.
It's not a bad gig. It's not a bad gig. It's not
For a
bad.
couple of months, gets 100 grand a year every
But
year.
yeah, it was
for the rest
during
of life.
her reign. Well, I say reign like she's a queen. What's the terminology for it?
In power, I suppose.
Yeah, as Prime Minister.
Yeah. So why did yields climb extremely aggressively? So the issue, why you got to remember, is why did the pound sell off so aggressively? So pound or GU sold super low, like it went like that.
You got very close to parity, right?
Very close, like 102. We sold it from 138 actually during 2021.
We're gonna come on to your mad swings in a minute. Yeah.
So yeah, the issue or the way why the bond market just went into frenzy is because the way Truss was presenting and Kwarteng as well, the way they were presenting it is they're going to do all these tax cuts, which is good for the economy, but that money has to come from somewhere.
Yeah.
So the markets are like, well, where is the money going to come from? And then all of the issues with issuance and again, as we was mentioning about how yields climb, it increases the volatility or increases the likelihood of you defaulting. The market's like, nope, we're selling every single bond we own. Yields climbed as a result of that, and yields spiked. And that created that worrisome in the market. So yields can climb and the currency falls, but it's important to don't think of it like it's not a one-to-one correlation. Nothing in the market is one-to-one correlation. It's the context as well is important.
Maybe, yeah.
The context is important. So like we was mentioning earlier about how inflation rises, currency rallies. Sometimes inflation rises, central bank increases rates, currency weakens. So that may be because one, as rates are rising, as we was mentioning, becomes more and more and more indebted, becomes more and more risky. But if the economy is really weak anyway, that just applies more pressure, and that weakens the currency further. So pound, perfect example, in 2022, sold off fairly drastically because the UK economy was not great. Inflation was rising. Bank of England was pretty hawkish. Gilt yields were rising as well. But the markets are feeling that as this is going to apply more pressure. So let's sell the pound. That's what they did. So yeah, the bond market all interlinks with each other. It's really, really interesting. Personally.
Where would you advise people to begin to learn? Yeah, beginner steps.
I just started Googling YouTube videos, to be honest with you. I watch a lot of live.
Do you put anything out yourself in regards to these things?
We obviously, from the collab with Zayn anyway, on Thursday, we cover all of that. But, it's going to take a lot of work, don't get me wrong. But from a research perspective, you got to remember, firstly understand the basics of fundamentals. So what I was mentioning about the GDP, the inflation, the interest rates, central banks as well.
So you want to learn that first. That's like your foundation.
Have that first, because you don't want to move on to a really complex without understanding the basics, right? You're going to get confused. So then you go and say, okay, I have a really good foundation now. The bond market is now the next step or the application. What drives the bond market? Why does the bond market move? So all you got to do is just apply the same framework you had with the FX space, apply it to the bond market.
How important would you say asking good questions is as a learner, as someone who needs to master this skill set? Because as you said there, what is the bond market? These are questions, very clear, very simple questions to a degree, but like it's a complex subject. How important, even as a technical trader, how important is it to ask these questions as you're trying to master the skill set? Because most people, as I said, they're in the losing position.
Yeah.
They're not where they want to be. They're not at that winning stage. They're not at that consistently profitable stage. Nothing wrong with that. But the issue is, I find, is that the majority of people are lazy as well. So they're lazy and not profitable, right? And therefore, what is it that allows them to be profitable? And I would say, based on obviously our conversation as well, is that asking good questions is such a very simple yet powerful tool to make that change. What from your experience and obviously working with other traders as well, what would you say to that?
It's definitely a big aspect of your journey. So you obviously need to have a good mentor. If you don't have a good mentor, you can just ask good traders. Like, how did you get into that position? Like, what did you do differently? You don't have to exactly copy and paste it because you want to be individual, of course. But just apply the sort of the logic behind, maybe their work-life balance is good. Maybe they've got a good relationship at home because, again, all of this outside stuff, forget about the FX, it bleeds through into your sort of trading. So ask the simple questions like, how well am I sleeping? How well is my relationship at the moment? Is there any issues I've got? Am I doing a lot of exercise, which is important? So ask the most basic questions first. And in terms of the trading aspect, then it's a lot more simpler. Now you got to think, okay, I'm doing this, or I'm marking at this demand level or this order block or support. They all work, technicals, every single thing works. Why are you looking at it from this aspect? Why are you looking at it down from here rather than up here, for example? So just ask the most basic questions in terms of trading. But yeah, ask yourself the most important ones first, which is, how's my sleep? Because if you have bad sleep, then again, we've all, woken up on really bad sleep. You think you're going to trade really well in that environment? Of course not. So just ask those questions first, and then just the simple ones of trading. Why did you do this differently here? Or, ask other traders as well.
Well, you mentioned earlier a particular trade, selling from 1.38, right? Comes down towards parity on GU, yes. So the real question that sticks out to me there, I'm sure there's other things in terms of strategy, which we'll come on to, but the real one is obviously those issues with the pound, the dire issues when we were getting towards parity there, they came out as we were closer to parity. So what allowed you...
So that you want the application of fundamentals to technicals. Is that...
Yeah, well, I'm wondering, how did you then swing from up there? Because at that time, no doubt if it's at a high or at a high point, no doubt because price is there already, what were the indications to allow you to sell and hold rather than obviously thinking, because I'm guessing to be at that high point, my guess would be, or my assumption would be that pound must have been at a strong point.
It was, yeah.
Right? So what was it that led you to say, okay, let's take this position and we have the confidence to hold?
Yeah, okay. So like I briefly mentioned it before, but think about why the markets are moving. So why did GU pump from all the way at the lows when the dollar rallied really aggressively? Obviously, that pushed GU lower to then rally extremely high to towards 140. Think about the reason why that rose. So it rose because the UK at that time was doing a lot of their COVID vaccines really well. They were one of the first and one of the fastest in terms of their vaccination. So the thought process was then, okay, the UK is now going to go back to normal quicker. So that means growth is going to be a little bit better. Inflation is going to rise as a result of that reopening. What do you think happens then to the Bank of England? So if inflation is rising, they then...
increasing rates?
Yeah, that thought process. They don't have to necessarily do it at the meeting, but
I'm disappointed in myself then. Disappointed.
The thought process is that. So that then allowed, okay, growth is getting slightly better. The vaccination process is getting really good. That creates that risk on environment. Pound is a risk on currency. That drove the pound higher. We then got to a point where at the time, the dollar sold off super aggressively. So thinking about those HSBC trading rules.
Yeah.
To then now the recovery in the US was starting to happen, whereas the UK was starting to peak that data. So that convergence, when it's like this, drove GU lower. So all you're doing is think about the reason why it rallied to then think the opposite. So the reason rallied, data was good, COVID, et cetera, et cetera. Oh, now we're starting to see a switch in that data. Oh, now GDP is coming in slightly weaker. Oh, inflation, yes, is coming in slightly better.
It's like a domino effect.
Yeah. And now you think, okay, unemployment rate's not good. Oh, the retail sales is poor. Services PMI is not great here, et cetera. Or the components within PMIs. Now what you're doing is just comparing. Because remember, you're trading GBP, the UK, versus the US economy.
Yes.
Similar to, and I think I saw one of your reels, I think one of your guys from SFT about Eurodollar. It's a pretty good reel. You're trading Europe versus the US economy.
Yeah.
So all you're doing is you're trading the UK economy versus the US economy. You're comparing the data, and then that gives you an idea to trade it. Now, the application to that's very different. So there's two elements to trading. There's the fundamental view, so the overall view.
Yeah.
And there's the tactical view. So, for example, as of right now, we are fundamentally bearish the dollar because, again, as the Fed starts to cut rates, it becomes better for risk environment. That then allows the dollar to sell off. The Aussie dollar will rally. The yen will also strengthen as a function of the bond market. Yields will fall as well. So bull steepness is when 2-year yields fall quicker than the 10-year. 2-year yields represent policy because it's very short-term maturity. 10-year represents the growth of the economy. So as the 10-year yields are falling or the 2 years, that tells you everything there. So obviously, we're not going to get into that because it's a massive aspect of the bond market. But all you're doing is then thinking about a tactical view. So our tactical view is higher dollar in the near term, potential of hawkish Fed. But then we know at some point, we want to get into a long in Eurodollar. We want to get into a long in GU. We just got to think about timing. Timing is really important. So all we're doing is thinking, okay, from the GBP USD perspective is, oh, we're starting to see weaker data. Oh, structure's breaking. How convenient of that. So as I was mentioning before about how the fundamentals or the technicals is a reflection of what's happening fundamentally.
Yeah.
That's why sometimes when you see Wyckoff accumulation, markets are bullish, the dollar, they're just waiting. And that creates that consolidation. If you're trading two strong economies against each other, consolidation happens. If you're trading unsure markets because they're waiting for data, consolidates. So it's not necessarily a technical reasoning. It's just a fundamental reasoning. So all you're doing is then, oh, GBP USD is breaking structure. Then you apply your technicals, whatever technicals you want to use. RBC, capital markets, they use support and resistance. They use pivot levels. They use Fibonacci. Bank of America, similarly, they use support and resistance. They use Fibonacci. I can show you all their technical analysis. HSBC, they use simple levels. They use big key levels, 110, quarter theory. I think it's called quarter theory. 25s, 50s, 75s, and zeros. They use all that element. 125 for GU or 110 for euro dollar. They'll look at that level. They're not going to say, oh, it's breaking above it. Let's wait for the retest and buy it. Or, oh, it's pulling back into this demand. Let's buy or supply and sell it. They're going to use the fundamentals as a way of getting into that position. So they'll think, oh, timing seems right now. The reason it was rallying, oh, now that's starting to switch. Oh, structure's being broken. Let's wait for the pullback. Let's sell it. Their stop loss is actually pretty big normally. I've seen Goldman Sachs give a stop loss of 150 pips on EuroCAD. But obviously their take profit's massively low, right? So risk to reward ratio is in their favor. But yeah, again, it's just applying the fundamental view. Tactical view is the short-term view, what's happening as of today. Fundamental view is the longer-term view. Obviously, that takes a bit more work, a bit more experience, but that will come, of course. And then all you're doing is just working out, okay, technicals is breaking here. Fundamentally makes a lot of sense as well. Let's just get into sales. So that's all we did, is just waited for some structural breaks, because that gives us the element of, okay, now from a technical perspective, it makes a lot of sense. Because they work hand in hand, right? Fundamentals gives you direction, technicals gives you the entry. You want to work hand in hand with that. And that's all we did for GU. So then we just held it. And all we were doing is watching days. Oh, it's coming in weaker. We're not going to exit our sales. Why are we going to do that? It's going to go weaker. And we were just doing that. And then at the time, the dollar was rallying super aggressively in 22. And we're just comparing it, just constantly comparing. And then that gives us a reason to get out or to continue to sell it. So that's how we do it.
That's incredible. That's incredible. Now, again, I think I asked you this earlier. I'm not sure if I know the fundamentals was a part of the answer in terms of like having the confidence to hold. Was that simply it in terms of building that patience to hold those trades for that amount of time?
Yeah, that's it. Yeah. All you're doing is just, again, the fundamentals gives you that clarity, right? So you can't understand from a technical perspective. This is why technicals work to a certain degree. So you got to think, okay, there's a reason why the market's moving. All you're doing is following that reason. So if the reasons tell you it's going to go lower, why are you going to exit? Now, I know some people will think, how does this apply to your intraday trades? That's when you have to be more tactical with your positions. So, for example, if you entered this year, which we turned bullish the dollar from a tactical short-term perspective at the start of the year, because it was super overextended to the downside, the data was telling us cuts were going to get pushed back. So we think, okay, dollar's going to rally. Then all we do from a intraday perspective is only look for buys on the dollar. So, GU pushing lower. I'll wait for the pullback, like sell that. Or euro dollar's pushing lower. Wait for the pullback, sell it. Wait for the pullback, sell it. And that's what you're doing from a technical perspective, is running with that view. And don't go opposite to it, because then you're going against the whole market.
And then you're just going, is that the short-term view? But the long-term view is still the dollar's weak.
Yeah, that's what I expect. And so we're in agreement with like Goldman, BNP Paribas. We understand why HSBC are bullish it, because their data is still pretty good in the US relative to Europe. So euro dollar should be lower. I do understand that. But the way the markets are reacting is telling me otherwise. So again, that reaction function. Now, don't get me wrong. If we then start to see the data in the US print better and the dollar still rallying, then fine, we'll hold our tactical views. That could then switch into a fundamental view. So it's important to just follow the ideas and go with it. So,
and what do you think in terms of what do you need to see to see that change, right? So like right now you're thinking short-term bullish for the dollar. What is it that you're looking for to then switch that back?
So apply the same framework as we was mentioned before. Why has the dollar rallied? Number one, super over or extremely, sold off. Cuts are getting pushed back. That's the reason why the dollar rallied. Fine, we agree with that. Then all you got to think is the opposite side. So maybe for the dollar to sell off, we need to see lower inflation, which then leads to
rate Not cuts?
Yeah. Lower inflation then brings...
I'm getting there.
Yeah. It's not necessarily inflation comes a week. Oh, now they're going to start cutting.
It's just a
It's the
different variable.
thought process.
Yeah.
It's the thought process. Oh, inflation coming a week.
So how would it normally go down? I'm guessing normally it would go down where the inflation, let's say, comes lower, and then they say, okay, they don't just cut. They would then say in their next, say, FOMC meeting.
They'll be a lot more dovish, yeah.
Yeah. So do they not like come out straight and say, next meeting we're cutting? Will it more so be like where it's something's on the table? Like,
yeah, they'll
like,
say it more politically.
Yeah.
So they're not going to directly say it, but they'll say it in some very nuanced way.
Yeah.
And the markets would see that, oh, that's really, really dovish. And then they'll just watch the data up until the next meeting and say, actually, they're going to probably cut now because the data tells them to.
Is there anything, as someone who actually is in the fundamental side, is there anything outside of, say, Forex Factory and the usual sites that you're looking at that maybe the average person won't know?
Bloomberg, pretty good. Bloomberg I've used that for quite a few years now. Reuters is good. It's a free website as well. You can look at ING. ING is a bank. You can look at pound sterling. That's another website you can use for your data, or not your data, for your news. And there's, again, the Forex Factory and stuff like that is just giving you the calendar. That's all I use it for, is the calendar. I've always used Forex Factory since I started. It's really clean, really simple. I like it. Trade and economics as well. So that has the calendar on there, but then it also has all of the data you need. So trade and economics will give you the GDP data, the inflation data, the interest rate data. So yeah, from a news perspective, Bloomberg, Reuters, ING is pretty good. Pound sterling. So those four are pretty decent.
Is there anything that you pay for outside of that?
Not really. No, you can get a lot for free out there. I know a lot of people are like, oh, you can pay. You can if you want to. If you can afford a Bloomberg terminal, buy it. But if you got $24,000 to just splash away at a software, fine. But you don't need to. A lot of the stuff out there is for free.
Yeah.
Remember, the data will tell you what's going to happen.
Yeah.
The news articles is just a reflection of what the data has said. So that will say, oh, Bloomberg has said inflation's coming weaker, maybe the Fed's more dovish. Or ING said PMIs is coming weaker, that means the Bank of England's now going to be more dovish.
Yeah.
So it's important to understand the data. And then the news and stuff is just a clarity, I think. Just another confluence, if you will.
Definitely. Yeah. In terms of your technicals, is there anything... So you have the fundamentals, right? Is there anything specific, like a mechanical aspect to your technicals that you need to see?
Yeah, so my technicals are no different to everybody else's. So the issue for nowadays actually is a lot of the technical traders, they apply the same thing over and over and over and over.